Hello everyone and welcome back to Explain the Charts, your channel for in-depth technical and fundamental analysis. Today, we're looking at USDJPY, which has had an absolutely explosive week, driven by significant political news out of Japan. The primary catalyst has been the surprise leadership victory of Sanai Takaichi, who is now set to become Japan's next prime minister. Markets are interpreting this as a return to Abenomics, featuring expansive fiscal spending and continued monetary easing. This has led investors to dramatically scale back bets on any near-term interest rate hikes from the Bank of Japan, despite inflation remaining above its target for 3 years. This growing policy divergence between a dovish BOJ and a relatively hawkish U.S. Federal Reserve is the core fundamental driver pushing USDJPY higher. Simultaneously, the U.S. dollar index has remained strong, acting as a safe haven asset amidst political uncertainties in Japan and Europe. However, with this rapid ascent comes the looming threat of intervention from Japan's Ministry of Finance. Finance Minister Katsunobu Kato has already issued verbal warnings against excessive and disorderly movements in the yen, a factor that played a huge role late last week. Now let's bring that news to the charts. Looking at the daily chart, we can see the price was in a downtrend from a high above 160 back in July 2024, finding a very strong base of support around the 140 level in September 2024 and again in early September of this year, 2025. That 140 level acted as a powerful springboard for the rally we're seeing now. Let's zoom in on the most recent action to see how the Takaichi news directly impacted the market. Notice the massive gap up at the start of last week on October 5th. The price closed on Friday, October 3rd, around 147.43 and opened the next session near 149.50. This gap is a direct reflection of the market pricing in Takaichi's victory and the prospect of a much weaker yen. Following that gap, we saw 4 incredibly strong bullish days as the pair broke cleanly through the 150 psychological barrier and surged all the way to a high above 153. But after such a parabolic move, the market hit a wall on Friday, October 10th. Let's switch to the 15-minute chart to see this reversal in high definition. Here you can see the climb to the peak at 153.269 on Thursday. Then, on Friday, after some initial consolidation, we see a dramatic sell-off starting around 14:45 Universal Time Coordinated. The price plummeted from over 152.60 down to its closing level near 151.15 in just a few hours. This sharp decline correlates perfectly with the timing of those verbal warnings from Japanese officials, which spooked the market and triggered a wave of profit-taking. Returning to the daily chart, Friday's price action has formed a very prominent bearish reversal candle. This candle signals significant selling pressure at the recent highs and suggests a period of consolidation or correction is likely. The immediate battle is happening right now around the 151.00 to 151.50 area. The first major support level to watch below this is the critical psychological and technical zone at 150.00. This level was a major resistance on the way up, and the classic technical principle is that old resistance becomes new support. A break below 150.00 would open the door for a much deeper correction. As mentioned in some market reports, there is a large unfilled gap on the chart from last week's open, with the bottom of that gap sitting around 147.50. In a strong bearish scenario, the market could push to fill that gap. To the upside, the resistance is now clearly defined by Friday's high, right around the 153.30 mark. A confident break and close above this level would invalidate the bearish reversal candle and signal a continuation of the powerful uptrend. The next major target would then be the February high around 154.80, followed by the 155.00 psychological level. So, let's recap the key levels and potential scenarios. Keep your eyes on resistance at 153.30, 154.80 and the longer-term psychological level of 155.00. Key support lies at the current zone around 151.00, the major level at 150.00, and the potential gap fill target at 147.50. Fundamentally, the long-term bullish case based on policy divergence remains very strong. However, the short-term picture is now clouded by the bearish reversal and the real threat of currency intervention. Our most likely scenario, with about a 65% probability, is a period of consolidation between 150.00 and 153.00. The market needs to digest the recent massive gains and assess how serious the Japanese government is about defending the yen. A secondary scenario, with a 30% probability, is that Friday's fear-driven sell-off continues, breaking below 150.00 and pushing towards the 147.50 gap fill. This would likely require stronger intervention threats or a significant piece of weak U.S. economic data. The key thing to watch moving forward will be any and all commentary from BOJ and Japanese finance officials, as they now hold the most power to move this market in the short term. And of course, upcoming U.S. inflation data will be crucial for the Fed's next move. Finally, please remember that this video is for informational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research before making any investment decisions.